Hello everyone. I will cover chapter 10 in this lecture. This chapter is about insurance contracts. These are some of the concepts that we will cover in this chapter. So we start with the basic parts of an insurance contract. The first section is the declaration. So here we find the information about the property or any other entity that is being insured. So it gives the details of the insured individual, the location of the property, and so on. In the case of life insurance, it only gives the details of the individual who is being insured. Then we have the definition section. So here we have the meaning or the explanation of different keywords and phrases which are used in the insurance contract. Then comes the insuring agreement. The insuring agreement summarizes the obligations of the insurer or the insurance company. It can be of two types. The first is named perils coverage. So in this case, the sources of risk which lead to loss are mentioned in the agreement, and the policy will cover only those sources of risk. The other type is open perils coverage. So in this case, the sources of risk or the perils which are mentioned in the agreement are not covered. Everything else is covered by the insurance policy. Insurance contract will also have exclusions. That is, the conditions under which the policy will not provide compensation. So it can be excluded perils, which are the sources of loss, excluded losses, is the activities in which losses occur, and excluded property, that is, entity which is not covered by the insurance. So why are exclusions necessary? Because some sources of risk are not commercially insurable. Example, catastrophic losses. Sometimes above average risk is present, so it does not make sense to cover them under normal insurance. For example, in auto insurance policy, the exclusion is that the vehicle will not be used as a taxi. In some cases, it is more feasible to provide coverage through a different contract. So some conditions are excluded. It also helps to reduce moral hazard problem. If certain conditions are excluded, then the customer will not have the tendency to take undue risk. Otherwise, they will have to pay for the losses on their own. It also takes care of attitudinal hazard problem. The insurance company does not end up paying for carelessness or indifference of the customer. In such cases, the customer has to pay from their own pocket. And sometimes it is not feasible to cover certain activities or entities in that insurance. For example, homeowners policy cannot cover aircraft insurance. Then we look at conditions. Conditions are the provisions which place limitations on the insurer's obligation. If the conditions are not met, then the insurer can refuse to pay compensation when the loss occurs. There are other provisions in the insurance contract, such as terms and conditions for cancellation, subrogation, and so on. Now we look at the insured entity. So insured entity is the person or group of person or any other entity mentioned in the insurance contract who is insured under this policy. So name insured is the person or group of persons who are mentioned in the declaration section. The first name insured has additional rights and responsibilities. The policy also covers some individuals who may not be explicitly mentioned. For example, children of an individual can be covered in an insurance policy, even if they are not explicitly mentioned. Additional entities who require insurance may be added through an endorsement in the policy. So what is an endorsement? Endorsement is a written provision which changes the existing provisions of the insurance contract, like adding additional individuals to the policy or maybe making changes to the terms and conditions. In life and health insurance, it is called a provision. Rather, it is called a rider. It is a provision which helps to change the original policy. Now we look at deductible. Deductible is a provision which helps the insurance company to subtract a certain amount from the total compensation paid to the customer. The idea is to eliminate small claims which are otherwise more expensive to handle. It also helps to reduce premiums and also reduce moral hazard and attitudinal hazard by the customer. What it means is that up to a certain limit, the customer has to pay out of pocket. Once that limit is exceeded, then the loss will be compensated through payment from the insurance company. So if the customer is ready to pay some part of the expenses, premium goes down, they also become careful and they don't take undue risk, or they are not careless so as to prevent the occurrence of risk. Deductibles can be of two types. One is straight deductible, that is, the customer has to pay a certain amount of money, after which the insurer starts to make payment. The other one is aggregate deductible. So in this case, the losses that occur during a certain time period are aggregated, and the deductible amount is based on the aggregate amount. It is generally used in commercial insurance. Calendar year deductible is a type of aggregate deductible, and it is mostly used in health insurance. There is also another type of deductible called elimination period. So once a loss occurs, there is a certain time period during which no insurance payout happens. So the idea is the customer will take care of loss related expenses for a certain period of time, after which the insurance company will pay out. So that's all for chapter 3, chapter 10 in this lecture. I'll continue with the rest of the chapter in the next lecture. Thank you.